Welcome into EP Wealth Advisors Informed Investor Market Update. I'm Rob Black. Joining me today is Adam Phillips, Chartered Financial Analyst, CFP, Director of Portfolio Strategy with EP Wealth. Bang, the year started off with quite some drama. Year to date, the Nasdaq's down 4.5%, the S&P 500's down 1.8%, the Dow Jones Industrial Average down about 0.25%. 10-year Treasury is noteworthy. It's moved up to 1.8% level. Can't stand the heat. Get out of the kitchen. Bitcoin's down 10%. Ethereum is down 12%, showing you how quickly we fall out of grace at times on Wall Street. Adam, what's the story of the year so far? What's driving these markets?
Yeah, I mean, it's hard to choose just one, but it's definitely not the start to the year that investors were looking for. I think as some of the numbers that you touched on there in the beginning are really speak to the weakness in technology, in the technology sector. I think a lot of that is really being driven by this jump in rates. So 10-year Treasury yield really jumped right out of the gate like we saw this time last year. And so what we've seen is that these technology shares, these companies that, as we say, have a higher duration, they are more interest rate sensitive. They really benefited from interest rates being as low as they have been. They're expected to be some of the first losers or biggest losers if rates start to move higher. And I think that's what we're starting to see here.
Goldman Sachs came out with a survey over the weekend where they're expecting 4 interest rate hikes to fight inflation in 2022. 4 is double what we were expecting from Fed Chairman Jerome Powell, who said maybe 2 in 2022. I might be paraphrasing here a little bit. How much should we be paying attention to these interest rate hikes over the longer term portfolios versus the shorter term that some people might have in retirement?
You know, look, 4 interest rate hikes when you're at effectively a 0% interest rate is not going to move the needle a whole lot over the long term. But I think over the short term, look, it's going to be what everyone's talking about. I think that Goldman Sachs was among the first to call for 4 rate hikes in 2022. The market has really gotten there too. If you look at what happened after last Friday's jobs report, it suggested that the labor market is even tighter than we all expected. So the jobs added for the month of December, we saw just under 200,000 jobs being added. So that was much less than expected, but we saw the unemployment rate fall down to 3.9%. So it tells you that the jobs market is extremely tight right now. There's actually about twice as many job openings as there are unemployed individuals. And so it tells you that what this means is that sends inflationary pressures, wage pressures higher. And so that means that there's just less and less of a reason for the Fed to remain as accommodative as they are. They're still buying bonds right now on a monthly basis. They are tapering, which means that over time, they're going to wind that down, probably get down to 0 net purchases sometime in March, at which point they will be free to start raising interest rates. And so I think the market is saying, look, March is a live meeting. It could be when we see the Fed raise rates for the first time. And it's not going to be their last time for this year, for sure.
I like talking in digestible nuggets, if that's not all possible. The jobs report, let's stick with that for one more second. Friday, under 4%. Goldilocks would say that's too hot. Any number 4% create inflation. Any number at 6% can kind of create a looser economy. Is this all about we want to get to like a sweet spot so that employers don't feel challenged to raise labor costs? Or is this something we just get through and we go 4% is a pretty good number, but we have to digest the inflation that comes with it?
You know, it's interesting. The unemployment rate is the one that a lot of people talk about because that's what the Fed is watching, but it doesn't tell the whole story. Some people focus on the monthly additions to payrolls. I mentioned that close to 200,000 jobs being added in the month of December. That doesn't tell the whole story either. And so we really have to look at a whole combination of factors. Where is the job growth coming from? We saw earlier in the week, we got the Jolt report, and that showed that there are still close to 11 million job openings in the US. There were a record number of quits, meaning voluntary separations from jobs, about 4.5 million job separations, about a little more than 1 million of them coming from the leisure and hospitality space. And so not surprisingly, it is still extremely hard to find workers in that field. And so you're seeing a lot of upward pressure on wages there. And I think that's what we need to figure out is it's great that everyone that it appears wants a job can get one right now, or at least has one. but it's putting a lot of pressure on businesses in being able to work at full capacity, right? There are a lot of restaurants say that can't operate, can't utilize their full space because they don't have enough servers or waiters there. There are FedEx came out over the weekend and said, look, expect a little bit longer shipping times because we had trouble hiring. And then on top of that, those that do work for us, a lot of them are down with COVID right now. And so it tells you that it's just a really tricky jobs market, that the longer this persists, the longer it's going to create this upward pressure on wages, which is great. It's great that people are making more money, but at the end of the day, it does filter through to the bottom line. If companies don't pass that on to consumers in the form of higher prices. I think that's what we need to really worry about here.
I heard an analyst on Bloomberg this week or last week talk about tech stocks. They've been driving the market. They've had a 10-year great run. These are the names like the Amazons, the Googles, the Facebooks, the Microsofts, the Apples. They're overweight the index. One of the things he said that I found interesting, I want to run it by you, is he said, if you've got a time horizon of 3, 4, 5 years, tech stocks will figure it out. Don't worry about that. But in the short term, it's kind of a correction of a reevaluation. Do you believe that statement, that it's short-term reevaluating or reevaluating the value that we'd slap on a stock per se?
I think it's really important to look at those larger tech companies because they've been leadership for several years now, and that's where the majority of returns are coming from. We have to remember that if we look at the S&P 500, it's a cap-weighted index, meaning that those largest companies have an outsized influence on the daily performance or on the yearly performance of the broad index that we're always talking about. And so I think over time, if you see that relative performance, you see that outperformance continue for long enough, then that means there's a lot of value outside of those names. And I think that's what you're seeing here is this rotation away from those technology shares into other shares that really haven't participated to the same extent. I think that these technology companies are going to be, they're still a great place to be, most of them, right? And a lot of them we hold within our own portfolio, but I think it really speaks to having diversification within your portfolio. So if it's over the short term or even over the long term, we know that these companies are going to remain the dominant companies. I think most of us feel pretty confident that they're not going anywhere. But I think that it really speaks to just having diversified portfolio.
Now, I don't want to speak for EP or for you, but the portfolio that you've put together, are you getting together with the IPC, the Investment Policy Committee, and saying, hey, we got to start thinking more inflation is sticky, not as transitory? Are the decisions on inflation reflecting in like maybe energy exposure, utilities, financials? Is there a shift is what I'm getting at? And you don't have to be terribly specific because I know things change quickly.
Yeah, well, it's a great question because inflation's top of mind right now. It's really been on our radar for quite some time, though. And so we have been preparing for the risk that inflation sticks around a little bit longer than we had anticipated. And we're starting to see it, last probably a little bit longer than we had initially thought. And so we're happy with our exposure right now. We have within our portfolios that have individual stocks, we have overweight, meaning higher than the benchmark weighting to sectors like energy for inflation protection. We have overweights to areas like financials, which are going to benefit when we see yields move higher the way that we've seen so far this year. So we're happy with that. But even outside of the equity allocation or stock allocation portfolios, we have specific allocations to commodities for inflation protection. We have within our bond portfolios an allocation to floating rate bonds. And so the idea there being that if the Fed does start raising short-term interest rates, these are the things that are constantly resetting the interest rates. They are floating rate. So based on say 30, 90-day LIBOR. And so you can actually hedge against that risk of higher interest rates, higher inflation by having an allocation to these bonds. So it's definitely something that we're seeing play out in the economy. And therefore we want to protect portfolios for that.
I like giving some soothing words when the markets get dramatic, buying opportunity, things along those lines. You want to see some stock buybacks. What are you looking for in the current market to get a little bit of peace, so to speak? And again, I like down markets. I like sales. That's the way I look at them, but my perspective is not your perspective. So I'd like yours.
Well, I think that's right. Is that we like sales too. It's nice to get more attractive entry points for sure. But look, I take this and I'm actually I don't like to see the stock market go up in a straight line. I think it's great if you're looking at your portfolio and you see that your portfolio is doing great. I think that obviously makes you feel good. But as an investor, you don't want to see the market move in a straight line because that's not what it's supposed to do. You don't want to see investors get complacent. You don't want to see a one-sided market. And so it's good to see investors start to acknowledge some of the risks that are out there. We don't think that this is necessarily going to turn into something too sinister. I don't know if the volatility we've seen is fully flushed out yet, because I think there's still a little bit to get through here. But I do think that it's important. It shows you that investors are paying attention. They're paying attention to the risks of policy being removed from the economy, and so losing one level of support that's been driving stocks. Maybe the threat of higher inflation, what higher bond yields mean for technology shares. This is all good. You want to see the market start to account for that. And I think you're seeing that play out. But I think that it's important that even though the market as a whole has been selling off, I think some areas have been doing worse than others. And so I think that's also important to acknowledge, right? We talk about the weakness in technology. Well, even though we're seeing the broad market sell off, it doesn't mean that every sector is really feeling the pain right now, or the pain to the same extent. And so I think that's important for investors to know as well.
So let's finish up with the Fed. And right now I feel my wealth deflating in the first 7 days of the year. I know that sounds ridiculous, but there's a deflation which cuts inflation, which is a positive in the scheme of things. I read some commentary last week that the Fed can't really let the stock market fall 20 to 30%, and they can't really let the housing market fall 20 to 30%, and that our government will be cavalry if we need it. Is that about right, that the Fed and the government will bail us out if things get out of hand?
I think that's what the market has come to expect, right? It is that if the market starts to misbehave, the Fed will come to the rescue and come out with some kind of policy announcement, say they won't be as aggressive in raising interest rates, or maybe they're not going to look to wind down their asset purchases by March. They could come out with something like that, but at the end of the day, that's not their job. And so I think there's many that actually criticize the Fed for the appearance of even caring about what's going on Wall Street. It's really about Main Street. That's what's important, should be important to them, is maximizing employment and promoting price stability. That's their dual mandate right there. It says nothing in there about the stock market. But there are those who think that if the market starts to misbehave, that they will announce something. I wouldn't be banking on it.
Right.
And as far as the fiscal policy goes, I think the days of getting really a lot of help from the government, from Washington, due to the pandemic, and those days are over. And I think that the fact that there are more than almost twice as many job openings as there are unemployed individuals tells you that if people want a job, they can go and get one.
Right.
So they're not going to go and distribute these direct checks. I think that's highly unlikely. So I think if Wall Street is waiting for a bailout, or is banking on a bailout, should it come to that from policymakers, they're likely to be disappointed.
Well, I certainly feel better. Thanks very much. It's EP Wealth Advisors Informed Investor. Market update. I'm Rob Black, sitting in with Adam Phillips, CFA, CFP, Director of Portfolio Strategy at EP Wealth. Have a good day.